The anti-fragile retirement plan is a plan that doesn't break during the future shocks or unpredictable events that are going to come our way. And it not only withstands the shocks and the stresses, but it can actually improve or benefit from them. And the way to do this is to focus on creating a retirement plan that thrives in unpredictability and can even capitalize on positive opportunities that appear during that volatility. And there's 6 easy ways that anyone can apply this to their plan, whether you're a few years from retirement or you're already retired. So in this video, I'll share what is the anti-fragile retirement, and then how anyone can set it up, and then the 6 things that can be applied to make any plan become more anti-fragile. Sorry, that was the Italian pronunciation, if you remember the Christmas story. But let's get back to it. Before we apply the strategies, there's one term that we need to know, and it's actually one of the most overlooked factors in retirement planning. The nerdy way to say it is margin of safety. The normal way to say it is just room for error. And we know this is overlooked because people come to us every week who are working with an advisor, but they realize they want a specialist that focuses on retirement strategies. So we get to see their neatly bound financial plans and all the projections and the key assumptions, but there's a problem that we see a lot. There's little or no room for error built into the plan. As an example, take a plan that has estimated market return of 6% over the next 30 years. Well, what happens if the plan only does 4% and that's the average? Is it still successful? Right? The anti-fragile plan would say it would be great if the plan does 6% on average, but if it doesn't, if it only does 4%, it's still going to be okay. That's something valuable that you'd want to know. We have to consider that the more assumptions that your plan relies on, the more fragile it is. A margin of safety, or that room for error, provides just cushion for error. Now, this isn't being overly conservative and trying to avoid risk entirely, but rather it's really about improving the chance of success within our given level of risk. This margin of safety principle is valuable because it acknowledges the uncertainty in the financial markets and our own personal life, and then it encourages flexibility and prudence in your plan. Now, let's look at the 6 strategies to create a retirement plan that has room for error and is less likely to be derailed by unforeseen events or less than ideal market conditions. And by the way, if you listen to this and you like the idea of creating an anti-fragile retirement plan, please like the video, and then hopefully more people can see this. Number 1, I already mentioned it, and that's just growth rate. If you settle on an investment mix that has historically returned 6% per year, that's great. But think about looking at the plan and then what happens if it's 4%, if that's the growth rate, or what happens if it's 8%. Look at both of those. Number 2 is the bucket withdrawal strategy. This can allow you to be more anti-fragile because you can have a number of steady or safety money for an extended bad market scenario. And that's just, you've heard it before, it's the conservative bucket and the growth bucket. This can give our clients a level 10 confidence in scary times or bad markets, so they don't have to feel like they need to sell when things are down because they have a place to go. In bad markets, our clients look at the money in that conservative bucket and they see quite a few years worth of withdrawals that are not getting impacted by the ups and downs of what's happening in the market. And remember, an anti-fragile plan not only survives, but actually thrives during bad times. So during what they do, because of this, they could take advantage of when things are down. And one way they do this is through trigger-based rebalancing, right? And that's one of the keys behind this whole bucket strategy is the actual active rebalancing and paying attention to that. A quick picture of what that actually looks like is this. And you've probably seen, this is a very simple version, but pretend you've got the 60-40 portfolio starting here. Stocks go up and they take up a bigger piece of the pie. Well, maybe when you were saving money, all from ages 20 to 60, maybe that's okay. And you can afford to have this pie continue to get more and more, call it risky for lack of a better term in this video. But as you get closer to retirement, maybe more predictability would make sense. So sell stocks, balance out the portfolio back to 60-40. But what happens if stocks go down? Well, then you start to get more conservative, like in March of 2020, and then that's when you buy and get back to normal. So there's a lot of nuance behind that, but that's just a simple picture of how to take advantage during these ups and downs. The third way to have an anti-fragile plan is to diversify among different market seasons. Many people think that a four-fund solution that has 60% stocks, 40% bonds is diversification, and it is, and it can actually work for many, many people. But there's a certain kind of retiree who sees the wisdom in being invested so that they could take advantage of any economic season, whatever it is. So how do we do that? Well, first, we have to know that there's only 4 major economic seasons that we can go through, and know that it's a fool's game to actually think we can predict what season we're going to go through next. Like Peter Lynch, a famous investor, said, if you spend 13 minutes a year on economics, you've wasted 10 minutes. But we don't have to forecast. We just need to know the 4 seasons and then have asset classes that can fit and have historically done well during those 4 seasons. So quick recap, the 4 seasons are higher than expected inflation. We're familiar with that one. Or lower than expected inflation or deflation, and then higher than expected economic growth or lower than expected economic growth. As an example, during a period of higher than expected inflation, where stocks and many bonds were down in 2022, investors who had commodities or short-term inflation-protected bonds had an income source that wasn't getting as impacted as other stocks and other bonds. So during that period, they had asset classes that they could access if needed. So that's a way to become more anti-fragile, or have the plan be anti-fragile. Now, if you like these ideas and you're not getting them currently, reach out to us by clicking the button below or going to streamlineplanning.com and then click Get Started. But on to number 4, the way to have anti-fragile retirement has to do with your withdrawal rate. If someone had a plan that's withdrawing 5% per year, and then they showed a 99% chance of success, well, it makes sense to find out how much of that 5% is flexible, just in case it needs to be adjusted. It doesn't mean that you have to change anything, but just knowing this can increase your confidence. And the easiest way to do this is to define your needs, which are house expenses, food, medical, the things that we must have, and then your wants, which is the travel, the entertainment, or the golf memberships. And having some flexibility in your withdrawal plan can really lower the pressure on the overall plan when you know what's needs and what's nots. And I'll include a withdrawal strategy that you don't hear about often coming up. And this can actually allow some people to actually spend more in retirement. Now, number 5, that's related to spending, and that is healthcare planning. Specifically, building into your plan, what would it look like if there was a earlier than needed long-term care expense? Most of our clients can self-insure for those big expenses, but maybe it's worth exploring what happens if you do need, if healthcare costs go way up for a period of time, or explore long-term care insurance costs. That can be helpful. And then number 6 is inflation rates. So looking at the results of different expectations of average inflation could be useful. There's this risk actually that's called sequence of inflation risk. And I plan to do another video on that coming up in a few weeks. On to number 7, that's taxes and tax mitigation. So this is an extra. I guess I've got a few more ways than I originally thought, but looking at the various future tax rate scenarios could be helpful if you have a large portion in your retirement savings, like a 401k or traditional IRA. When you take money out of there, all of it's taxable. We know that we can't control tax rates, but we can control how much is taxable. This is really related to the tax efficient withdrawal strategy, which is it's part of your total income strategy. And that's one of the big 3 things you got to get right in retirement to really optimize things. The other 2 are investment strategy and then just overall tax strategy. So income, investment, and tax strategy. And I've got future videos in the queue, more on tax planning. So be sure to subscribe so you don't miss that. But the big takeaway is have multiple what if scenarios in your retirement plan, because the less we can rely on assumptions having to be right, the more room for error we can build in, and then the more valuable your plan becomes. And then the more confident you become too. So if you're looking for that video on how to spend more in retirement with that little used withdrawal strategy, you can find it here. And if you're subscribed, click on the bell icon, and then I'll see you next week. Take care.